Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The Commonwealth Bank has had an incredible run lately. It's closing in on becoming a $200 billion company, and a recent surge in its share price means it's now more than twice the size of National Australia Bank and Westpac combined. Mind you, the other big three of the big four have done pretty well also. So, how far can the banks go? What happens to CBA if interest rates do start to fall this year? What about the other banks? Remember, this is general information only, and you should seek professional advice before making investment decisions. Cacho is the bank analyst at Jarden Australia. He's also Jarden's chief economist, a very, very busy man. Carlos, welcome back to Fear and Greed.
Thanks for having me, Sean. Always a pleasure.
So we'll get to the Commonwealth Bank in a moment, but more broadly, what is it about the banks at the moment that investors like? They certainly have outperformed in the past a little bit.
Yeah, look, they've had a good run in the year to date, and really since kind of late October when we saw the peak in bond yields globally. I think the key driver of that has been rising expectations of a soft landing, both in the US and Australia. And what that means for banks is that probably credit losses, or effectively the losses they bear for loans going bad because people can't pay them, are likely to be smaller than people feared because the economy is holding up better, and we're now kind of at the point where we can see the light at the end of the tunnel in terms of central banks probably cutting rates later this year by and large. So generally, while banks do benefit from higher rates, it obviously creates risks for them as well, creates a risk of slowing down the economy, higher unemployment. So they seem to be kind of in the sweet spot at the moment of earning more on their mortgages or on their loans, but not taking losses on the credit because the economy is holding up better than feared.
Okay, just on that credit, we talked about the mortgage cliff last year and the idea that people were shifting from low fixed rate to higher variable rates. Is it that didn't happen, or is it much more than that? Is it that the economy hasn't tanked, therefore businesses can repay their loans, people can pay their credit cards? So it's broader than mortgages, I presume.
Yeah, look, it's definitely broader than mortgages, and generally what we see with the banks is that even though mortgages represent the majority of their loan books, the losses are more likely to come from the business side. Generally, a mortgage is, secured against the property, and even if someone falls into arrears, they can't make payments, there's still value there in the property, and so it's quite rare that we actually see, at least in Australia's case, where the banks take material losses on the mortgages. At the moment, the most recent estimates from the RBA have negative equity, so the instances where the loan is higher than the value of the property are less than 2% across Australia, which is the lowest it's been in a long time. And that makes sense given that the housing market has made record highs. So it's really about the business side. And what's happened over the last year is the economy has just held up a lot better than people feel. Unemployment is still sub 4%, while per capita GDP is going backwards. That population growth that brings it down is actually a big positive for businesses, and we do expect that's going to continue. And so it's, even though there's a lot of pessimism out there, in aggregate things are actually holding up a lot better than people would have expected. If you told an economist or a banks analyst 2 years ago that the cash rate would be over 4% and the unemployment rate would still be less than 4%, I don't think many people would have believed you.
Okay, now you mentioned also about interest rates and what that means for the banks. So I remember being a banking writer for the Financial Review, and the idea was that when rates rose, good for the banks, they can increase their net interest margins, effectively their profit margins. When they fall, bad for the banks. Is that not the case?
That is the case, and we have seen net interest margins rise, but it's only to an extent. And initially, during the hiking cycle, it was very positive for banks. Deposit rates rise slower than mortgage rates have. But over time, what we've seen is the banks have competed really aggressively on mortgages. We've actually seen a materially smaller increase in the average mortgage rate compared to the cash rate because of that competition. We saw about a 50 basis point, 0.5% decrease in new mortgage variable rates relative to the cash rate since the RBA started hiking. And at the same time, they've had to pay up more for deposits as households and businesses have been shopping around. It is still positive from an earnings or a revenue perspective, but as I said, it does create risks in that as people are paying more on the interest, there is a higher chance that some of them may not be able to repay their loans, and you can see bad debts rise. At the moment, we haven't seen that. Bad debts still remain very benign. They're kind of what I'd say is normalizing, but they're not going, they don't look like they're going to elevated levels. And the key things we're watching there for risks are things like unemployment, insolvencies, etc. And while there has been some stress, it's mostly been concentrated in areas in the economy that don't have too much debt, like the construction sector, where, yes, it's been a very challenging environment, but generally speaking, the banks have been making out okay in those situations. And unfortunately, it's the suppliers, it's the subcontractors, and it's the home buyers who've been kind of wearing the losses from these companies going under.
Stay with me, Carlos. We'll be back in a minute. I'm speaking to Carlos Cacho, Chief Economist and Bank Analyst at Jarden Australia. And I'm just reminding listeners that this isn't an investment podcast. You should always seek professional advice. Now, with that in mind, Commonwealth Bank, that has certainly been the strongest of the big four. Is there any particular reason? And I suppose what's thrown me a bit with the Commonwealth, they haven't been competing as aggressively as ANZ, for example, in the mortgage market. Why are they doing so well? Why valuation's everything? So maybe now they're a bit overvalued. I don't know. But, kind of the last couple of months, why have they outperformed?
Look, I think there's probably a few factors. You're right. CBA has stepped back from mortgage competition for a while. We saw in June they were the first bank to announce an end to their cashback. They've increased their front book mortgage rates. Those are the rates for new customers quite materially since then. We've kind of tracked an over 0.5% percentage point increase across a lot of their rates. In comparison, ANZ still offering a $2,000 cashback. So they are, CBA is not looking to grow shares aggressively. CBA's focus has been more on maintaining their proprietary channels. So that's kind of the direct customers that come to the bank, as opposed to growing through kind of more aggressive expansion in the broker channel like most of their peers have done. The view there is that perhaps that might be better for margins, but it does come at the expense of your mortgage book. In terms of why CBA has been performing so well, I think part of it comes down to timing. They're the only one of the big four banks that actually has a result in February and pays a dividend in February. So for anyone who is looking to receive the benefit of that dividend, you're going to want to own CBA now, and then you've got time to sell CBA and own the other three banks before it comes time for them to pay a dividend in May. So that's part of it, particularly for some retail investors or some income-focused investors. The other factor is that globally we've seen a rally in banks. US banks have risen over 20% since October. The Aussie banks haven't risen quite as much. They've risen about 15% last time I looked. And so I think there's probably a bit of a trend where some global investors are buying the banks. And often they might just buy, the largest bank, which is CBA. It's seen as high quality, safe, and there's not too much risk there. And then finally, look, CBA is it's expensive. There's no doubt about that. It's been expensive for a long time, though. I think if you look back at the history of analyst ratings and price targets on CBA, it's been an underweight or sell rating for most analysts for the last couple of years, with a target price that's probably averaging about in the 90s. And it's been trading, before this latest rally, it was kind of range bound between 95 and 105. And now it's up to, I think it peaked around 115 or so. So it is expensive. It's still expensive. It's probably still going to be expensive in a couple of months' time. That high valuation does create risks, but we don't necessarily see a clear catalyst that's going to change that near term, unless we see a bigger concern about an economic slowdown, higher unemployment, and bad debts coming back to the fore for the banks.
Just more broadly, investing in banks. So you've got the big four, but there could be a lot of change this year, particularly if we have the ANZ Suncorp Bank decision to come down later on. ANZ is trying to buy Suncorp Banks, been knocked back by the competition regulator. They've appealed that. We'll see what happens there. We have plenty of neobanks always telling us that they're using AI and all sorts of things to create stiffer competition. Yet the big four, they just keep going. Like they just seem to be able to have this dominant market position, and no matter what's thrown at them, they just still are part, 25% of the market.
Well, the thing with the banking is, we all think about loans, we all think about mortgages, and actually a lot of the time what's more important is the other side of the balance sheet, the liability side, which is your deposits and your funding. And that's where big banks get their big advantage. If you're a big major bank, not only do you have bonds that you issue out into the market, term deposits that you get from customers, but you're also probably the main financial institution for a lot of households and businesses. CBA likes to talk about, they call it the MFI share, and it's kind of into the 30s, I believe.
Sorry, what is MFI?
Main financial institution. So basically,
Yep.
If someone asked you who's your bank,
yep,
it's the one you'd point to. It's the one you have your everyday banking account with,
yep,
the one that you leave the money in. If you're a business where you leave the float, that you're going to pay your employees' salaries and pay your expenses out of. And that's really valuable because that is usually a pretty low rate deposit product that people use. And so that gives a big tailwind for the big banks because they get cheap deposits, they get cheap funding. And what we saw at the bottom of the rate cycle, in the midst of COVID, when interest rates are at zero, there was a huge amount of competition from all of these neobanks, all these non-bank lenders, the smaller lenders, because money was effectively free. Funding was very cheap. And so it was easy for everyone to compete. Now that funding costs have gone up significantly, those big low-cost deposit bases the major banks have access to are worth their weight in gold, quite frankly, and it's now much harder for some of the smaller lenders to compete. We've seen some of the likes of, I think it was called Nano Home Loans. They sold their book to AMP because they just struggled in that higher funding cost environment. And we know that some of the non-bank lenders are also finding it more difficult to compete with the banks. If you go back 2-3 years, they were writing mortgages at more or less the same rate as a major bank would. Now they're having to charge rates that are 1% to 2% higher because they just can't make things stack up if they compete that aggressively.
Carlos, thank you for talking to Fear and Greed.
Thanks for having me, Sean.
That was Carlos Cacho, Chief Economist and Bank Analyst at Jarden Australia. This is the Fear and Greed Business Interview. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.